Most of us think about a life insurance policy as just one thing, a safety net. But what if it's also a pretty valuable asset you could actually sell? Well, it is. But, and this is a big but, unlocking that value means you've got to navigate what can feel like a maze of really complex tax rules.
So it's a great question, right? And the answer is a definite yes. There's a whole process called a life settlement, where you can sell your policy on a secondary market for cash. And we're not talking about pocket change. It's often way more than the policy's surrender value. Suddenly, that safety net transforms into a liquid, financial asset you can use right now.
For the longest time, the tax side of selling a policy was, let's be honest, a total mess. It was super confusing, and a lot of sellers got hit with a surprisingly huge tax bill. But the good news is, the rules have changed, a lot. So in this explainer, we're going to give you the map to get through this once tricky terrain. Okay, so to really appreciate how much better the new rules are, we kind of have to take a quick look at the old tax trap. See, before 2017, the way the IRS handled these sales could actually make you pay taxes on money you never even really got. I know, sounds crazy, right?
You can really see the whole story unfold on this timeline. Back in 2009, the IRS dropped this ruling that created a massive headache, this so-called phantom tax. It took until 2017 for Congress to step in with the Tax Cuts and Jobs Act and finally fix the problem. And then the IRS made it official with their own new ruling in 2020.
Now this is the whole ballgame. It gets right to the heart of the change. The IRS used to have this consumption theory. They'd argue that part of your premium was just used up every year buying protection. What that did was lower your cost basis and create a bigger taxable gain. The new investment theory is so much cleaner. It says, nope, every premium you paid was an investment, which, as you can imagine, is way, way better for you, the seller.
So what was the big turning point in all this? It all came down to one piece of legislation, the Tax Cuts and Jobs Act of 2017. This law completely rewrote the rulebook and finally leveled the playing field for anyone selling their policy.
Honestly, this was a watershed moment. The TCJA came in and just flat out overruled that old consumption theory from the 2009 ruling. It made it crystal clear that your cost basis, which is just the total amount of premiums you've paid in, should not be reduced by some internal imaginary cost of insurance. And here it is. This is the exact language from the law itself. It might look like a bunch of legal jargon, but this one sentence single-handedly wiped away that unfair phantom tax. It means every single dollar you paid in premiums now counts towards your investment in that policy.
So let's boil it all down. What does this mean for you? It's simple. A higher cost basis means a smaller taxable gain, and a smaller taxable gain means a lower tax bill. It's that direct. This change finally puts sellers on a fair and equal footing with people who just surrender their policies.
All right, so now that we know how we got here, how does this new roadmap actually work? Well, it's a really straightforward three-tier model. It breaks down the money you get from the sale in a super logical way.
I love this analogy. Think of it like a waterfall. The cash you receive flows down and fills up each of these three buckets, one at a time. First, you get your own money back, tax-free. Then you account for the policy's growth. And finally, you get to the profit you made from the sale. So let's start with Tier 1. This is the best part. The first bucket to fill up is your return of basis. This is simply all the money you ever paid in premiums coming right back to you. And the best part? It's 100% tax-free.
Okay, once that first bucket is full, the water spills over into Tier 2. This part covers the gap between what you paid in and the policy's cash surrender value. Think of this as the policy's internal investment growth. The IRS sees that as income, so it gets taxed at your ordinary income rate. And finally, any money left over after filling those first two buckets flows into Tier 3. This is the true profit from selling your policy as an asset. And the great news here is that this portion is taxed at the much more favorable long-term capital gains rate, which is usually a lot lower.
Okay, theory is great, but let's make this real with some numbers. Say you sell your policy for $100,000. You've paid in $45,000 in premiums over the years, that's your basis, and the policy's cash surrender value is $50,000. So, following our waterfall, that first $45,000 you get, that's your money back, totally tax-free. Then, the difference between the cash value and your basis, that's $5,000, is your Tier 2 ordinary income. And finally, everything else, the remaining $50,000, is taxed as a long-term capital gain. See?
All right, understanding the waterfall is one thing, but how do you actually report this on a tax return? Don't worry, the IRS has actually created specific forms to handle exactly this.
So the first piece of mail you'll get is a Form 1099 LS. This one comes from the person or company that bought your policy. It's super simple. All it does is report the total gross amount they paid you. That's your starting number. The second form you'll get is a Form 1099 SB. And this one is absolutely critical. It comes from your original insurance carrier, and it gives you the other two magic numbers you need for your calculation, your cost basis and the cash surrender value right at the time of the sale. So you've got these two forms. What do? You'll take these numbers and report the sale on Form 8949. Now, here's the key step. You have to make a special adjustment to separate out that Tier 2 ordinary income portion, which you report on a different part of your return. This little move is crucial because it makes sure each part of the sale is taxed correctly and, most importantly, prevents you from getting taxed twice on the same income.
Now, before we finish up, there is one very important exception to all of these rules. It's a special case designed to provide some relief for people who are facing really serious health issues.
So, exactly, what happens in this situation? When the person selling the policy is terminally or chronically ill, the tax code treats the sale completely differently. This is what's known as a viatical settlement. It's specifically for someone who has been certified by a doctor as having a life expectancy of 24 months or less, or who is certified as chronically ill. And for them, the tax treatment is a whole different story.
And here's the most important thing you need to know. If it's a qualified viatical settlement, the money you receive is generally completely tax-free. Now, you still have to report it. There's a Form 1099 LTC and a Form 8853 involved, but the bottom line for the person receiving the money is that it's not considered taxable income. It's a huge relief.
So, there you have it. The tax laws have finally caught up with financial reality. Your life insurance policy isn't just a safety net for later. It can be a powerful asset for today. The old penalties are gone, the rules are clear, and you have a roadmap. So the only real question left is, now that you know the rules, what is that asset's true potential value in your own financial plan?